Alrighty guys. So we're currently on this stream here. We'll just wait for things to get clicking. Welcome everyone, welcome everyone. If you're from my Discord, let me know. Let me know in the comment section. How's the audio sounding, guys? How's the audio sounding? Hello. How you going, Meeks? How you going, Micah? It's always interesting in the Discord. I've got people's names and I'm thinking, what's your real name? But Mike is your real name, I'm assuming. Got 7 watching. So yeah, today pretty much what we're going through is you guys voted, right? So I'm pretty sure there was probably about 200 votes, close to 200 votes. And most people wanted to talk about bias, how I find my bias. So we're going to talk about that. A lot of people as well wanted to go through macros. We can definitely go through that. And then the next kind of big category was just PD arrays, ICT PD arrays as well. So there were 3 kind of things that that we're kind of watching, that I was watching, that you guys wanted to see. So that's kind of what we're going through today. So what I might do, I might just type this in the chat, just so I'll let you guys know. Pretty much the first thing we're going to talk about is finding the bias. The second thing we're going to talk about is macros. The third thing is going to be just PD arrays. And the fourth thing, we'll just make it random. So usually what I do is, at the end of each of these live streams, I just give people a chance to ask any questions. That's the opportunity to ask questions, which is fine. But that's kind of what I'm working with at this stage. So yeah, what we're going to do, we're probably going to get into it. Those people that start to join, they can follow along. How's this screen looking, guys? Is that all right? How's the audio? How's the screen? Just before we get started. And as always, we've got the Masterclass PDF, which I'll make this available. Cool. I'll make this available later on. So we'll go through this later on, but that'll be available as well. So, the idea with these masterclasses is host them once a month. What I'm leaning more towards in the future is doing something more for the Discord students as well. We can even do something once a week or once a fortnight. So that'll be an opportunity there. But essentially with these PDFs, right, they're just summaries of what we've done. So if this is the first time watching this, we're going through these 3 things today. And I'm going to be showing you examples on the charts. If you have questions, send them through. Send them through as we're kind of going. I've got the iPad next to my screen here in the desktop, so I'll be able to reply to those as we kind of have a chat. So pretty much the most important thing that everyone wants to know is formulating a daily bias. Like how do you do that? How do you know where the market's going to go? Do you have an idea where the market's going to go, and how do you kind of project that, right? That's probably the important thing. So I'll make this a bit larger so we can see, but the first thing we're going to have a chat about is formulating a bias. Now here's the thing. If you're trading the 1 minute time frame like me, right? If you're trading the 1 minute time frame like me, a bias is important, but it's more of a intermediate bias rather than taking a bias in a higher time frame. So for me, a higher time frame bias is used to, I'll write this down, higher time frame, just to get the directional flow, right? For me, it's just the directional flow. But the lower time frame bias is more how I get my entries. So there's 2, in my opinion, there's 2 types of bias. There's per session bias, and there's also higher time frame bias. There's 2 things which you can talk about, right? So this is kind of where we started. Now, in this PDF, just so we stay on track, London session on Friday was a great example, right? A great example I want to kind of talk about, and I've marked out my charts here so we can see some examples. And I'll just tell you my thoughts, and if you're in the Discord, you know exactly what I was thinking, because I was posting all those things live to you. But let's go to replay mode just quickly, and let's go roughly to about this point. Now, If you know me and you know my channel, you know that I like to use macros, and macros are 10 minutes before and 10 minutes after every single hour, right? Macros are 10 minutes before and 10 minutes after every single hour. So if I get rid of all this is all hindsight, but we're focusing on this period of time. Now, what I actually saw here is I went on the 5-minute time frame, and we were actually respecting bearish PD arrays, that being like a bearish fair value gap. We had a market structure shift on the 5-minute, and we'd actually come up and respected this 5-minute bearish gap. Now, whenever I'm trading London session, I mark out Asian buy side and Asian sell side. So at this point in time, when you're talking about a bias, did I have a bias? No, I was completely neutral. And there's a key reason for that, which I mentioned in the PDF, where we're so close to the middle of both the Asian buy side and the Asian sell side. In my opinion, it could go both ways, right? It could go both ways. Now, on a higher time frame, yes, we've been bullish. Nasdaq has been like extremely bullish, right? But on a lower time frame bias, look at how much of the middle are in terms of the middle position. In terms of, if I grab my Fibonacci, look at where price is sitting. We're just below equilibrium, but we're roughly halfway between Asian buy side and Asian sell side. So in these types of situations, personally what I do, I stay neutral and I wait for the market to show its hand. I don't personally, like to try and predict things a lot of the time unless it's extremely clear, and we'll go through some more examples of that in just a second. So that's the 5-minute time frame. But then on the 1-minute time frame, what I noticed was that we actually were respecting this bullish fair value gap, right? Now, this is a situation where you've got bullish PD arrays being respected and bearish PD arrays being respected. My best advice, I'm not a financial advisor, but what I personally do is I just wait, right? And personally, I thought we're going to go to sell side first, right? Because of this. See that? 2 relative equal lows. So if I had to pick one, I'd go, okay, well, this is a 5-minute fair value gap, and that's a 5-minute fair value gap. We're respecting that. I anticipated we'd go lower first and then go higher, and guess what? I was wrong. And that's because in these situations, it's very tricky to formulate a bias when you're in between Asian buy side and Asian sell side. Now, what ends up happening if we play this out, and I had it marked out before, but what ends up happening is we bounce off this bullish fair value gap during this macro, which is these 2 lines that are represented there. And what happens? We take out Asian buy side. So in terms of formulating a bias, my best advice, when you're between 2 ranges, wait for the market to show its hand. You could have had a bullish bias here, and then you could have taken a lovely trade. But again, if you're wrong and you do trade, and I would have been wrong in this case, then obviously it would have been a loss. So for me, I'd much rather the market show its hand first, and then I can look for an execution, or then I can look for something to happen. So as we play price out here, once we've taken out Asian buy side, I would then be looking for shorts. Now, I called this in my Discord as well, right? I said, if we're going to go down now, it's going to be the 3 drives pattern or nothing, right? So if this inversion fair value gap's disrespected, we're probably going to go much higher. And what happens? We disrespect this inversion and we push up higher. Now, this price activity is crazy. That is crazy movement for London session. Extremely crazy movement for London session. So essentially what happened here, we took out this accumulation period, we took out all of these highs, and this was, I guess, a misjudgment on my side of things. But on ES, so if I just grab another chart here and we get 2 side by side so you guys can see, on ES or on the S&P, whatever you want to call it, on this particular day, right, let me just scroll back. ES had 2 relative equal highs, this high and this high. So if I draw a line across in time, see that? Equal highs. So where we actually were looking to take positions, the equal highs were the drawn liquidity, right? The equal highs were drawn liquidity. So this is where formulating a bias when you're in the middle of the range from Asian buy side and Asian sell side can be very tricky, and it's not the highest probability. That's just my opinion, right? So this is the first example where you're between 2 ranges, and what I'm saying there in terms of formulating a bias, yeah, you could go, it's 50-50, I'm going to take a stab at it, or you could just wait for the market to show its hand, and in this case, potentially no trades, and that's completely fine, right? It's completely fine. So that was on Friday, this one. And this is what I'm talking about in this example, right? When you have a look at these PDFs, obviously in hindsight, I can go back and say, yeah, this is what should have happened. But in the moment, it's not how I saw it. And in the moment, we're in the middle of the two ranges. So that's the first thing. And I mentioned that right here, right? If you're in between the range, 50-50. 50-50. We know that it's going to go to Asian buy side or Asian sell side. It should, right? When you're trading London session, you should be wanting to target the Asian buy side or Asian sell side. And a lot of people might have thought the same thing. Yeah, equal lows here, we'll target that first. But sometimes the market doesn't do exactly what you want it to do, right? And this is one example, right? That's one example of this. The second thing I wanted to go through was the AM session. I know a lot of people do trade the AM session here, the New York AM session. So we're going to have a bit of a chat about that. Now, this, I believe, was on the Friday session. So let me just get rid of the replay mode here. And let's go to Friday session. Cool. Beautiful. All right, so on this Friday session, guys, and I'm going to zoom in a little bit here so you guys can see. If you're trading the AM session, you're looking probably for price action from 9:30 onwards. Now, at this point, if you're here in the market, you're watching the market right here, and I'm just going to go back to replay. You're watching the market, right? What are we extremely close to at this point? What have we left? We left relative equal lows, and one of those lows is London sell side. So here's the next kind of thing. If you are close to buy side or sell side, then it's much easier to form a bias. So if you're close to sell side or buy side, it's much easier to form a bias, and let me kind of explain why. So I'm going to leave that here. If you're trading the AM session, right, look what's just happened. You're watching price here. This is pre-open at 9:30. You've taken out all this trend on liquidity. You've taken out a time-based liquidity point. This low here is time-based liquidity, London sell side. And watch this. We'll play price out a bit. As soon as London sell side's taken out, you can formulate a bullish bias. But why? Why can you do that? How do you know it's not gonna keep going down? Well, because of the fact that time-based liquidity is important liquidity. And we know the market only moves to target two things: liquidity or to fill an imbalance, right? Liquidity or to fill an imbalance. Now, what do you see here? What do you see here? For those that are watching at the moment, what's this called? What's that? On the 5 minute. What's this called? If I move this up, the space, what's that called? Civvy, yeah, Civvy. So here's the thing. You've taken out time-based liquidity. At this point, you can have a bullish bias. As soon as we see price heading down like this, you have a bullish bias because you know the market targets two things: liquidity or imbalances. And we've taken out liquidity, right? And here's the icing on the cake. And we've tapped into this 15-minute bullish imbalance. Therefore, immediately at this point, going back to the 1 minute time frame, immediately at this point, I'm bullish. If I'm trading the AM session, I'm bullish because I know the market's done liquidity raids and I know it's tapped into an imbalance. Now I just got to pick my entry model and pick my PD arrays to actually execute off, right? So that's really important. If you're close to buy side or sell side, that's much easier to form a bias, right? Once the market raises liquidity plus fills an imbalance or targets an imbalance, then target the opposing liquidity or imbalances. And we'll talk about that a little bit more as well, right? So as soon as price starts coming down, right, you can have a bullish bias from here. Up here, by the way, you can have a bearish bias. You can have a bearish bias. I know, Meeks, you answered that question. You might be able to answer this one too, but at the top here, I mean, personally, I don't trade pre-9:30, but say you were to take a trade, why would it be good to take a trade up here? What's all this? What's all that? Building up that dotted line. For anyone that knows, if you've seen a lot of my videos, if you're in my Telegram or in the Discord, you know I love this. Bounce, bounce. It's something that, you know, retail traders would use. And there'd be a lot of stop losses. Yeah, trend line liquidity. So you could have a bearish bias up here because, again, you know the market targets one or two things. It either targets liquidity or imbalances. So if you want to go short here, well, guess what? You can, because you've swept liquidity, right? You're respecting these PD arrays. And yeah, you could have gone short from here. Would I go short before market open? Probably not. But it just illustrates the point, right? That the market targets two things, liquidity or imbalances. Now, once you've done that and you've taken liquidity and you've filled an imbalance, the probability of having the correct bias increases. And that's right. That's exactly right. Yeah, you generated sell side liquidity. So I'm going to write this up. These are some points, right? So if you're taking notes, these are some really important points. So once the market has rated liquidity plus tapped into a fair value gap, it has satisfied the conditions for a reversal. Therefore, the probability of having the correct bias increases. That's an important point. That's a really important point, right? So, you know, once the market's rated liquidity and it's tapped into a fair value gap, it's satisfied the conditions for a reversal. Therefore, the probability increases. That's just what it is, right? So, once you've come to that conclusion, right, you have a bullish bias. The next part, which is probably, it could be the easiest part or could be the tricky part depending on your experience, is you got to find out a way to actually enter or execute this trade. And that's where the PD arrays come into play. Now, I've had so many people ask me, I'm going to kind of mix this together. I'm going to mix the bias and the PD arrays and the macros, but I've had so many people ask me, okay, well, what's your preferred PD array? Like, do you like bullish gaps? Do you like inversion gaps, BPRs, order blocks? Like, what do you prefer using as a PD array? I've found personally that fair value gaps and inversion fair value gaps cover like 90% of cases. 90% of cases you can enter off one of these PD arrays. Back test that, forward test that. And it's one of those things because a lot of the time you might have been in situations, I've been in situations where you want to enter off a bullish gap or a bearish gap and it doesn't exist. And you're like, oh, I knew it was going to go up. I knew it. I had the right idea, I had the right bias, but you know, I couldn't enter because it didn't actually tap my PD array. So focus on these two. If you're going to learn like ICT PD arrays, fair value gaps and inversions, and we'll talk more about those as this masterclass goes on. So I'll play this out. We tap into that 15-minute gap again. And look at the price activity here. Look at the price activity. It doesn't want to go any lower. Look at that accumulation, right? We create an inversion fair value gap and a bullish fair value gap. It's up to you where you enter from, guys. You can enter as soon as this candle closes or wait for the return. Either one is fine, right? But just don't expect that the market's always going to retrace to the bullish gap. It doesn't always happen. And then again, you could go for a long position. Where would your stop loss go? Now here's the thing, everyone's different. Some people do this, and this is actually something that people wanted to talk about as well. They wanted to talk about stop loss management. It was a very small fraction, but we'll talk about it for those that wanted it. On this trade, it depends how comfortable you are in the trade. How much do you trust it? Now, I trust it quite a lot, and here's why. There's trend line liquidity above. We've just satisfied rating liquidity and tapping into a 15-minute imbalance, and we just inverse this fair value gap. So I know the market always moves from premium to discount. My bias is bullish at this point, and bullish for the short term. Here's the thing, like, bias is really important to have when you're about to execute a trade. Essentially, bias could be thought of as where you think the market's going to go, right? If you're trading a higher time frame, maybe looking at higher time frames. If you're trading intraday or in a session, lower time frames is sufficient. So you could put your stop loss there, and in this gap, you could take partials, right? It's not even a 1-to-1. Obviously, you could hold it and see what happens for a 1-to-2. But the way to mitigate, your stop loss if you're in this situation, see this inversion fair value gap candle, you put it below one tick, below that. If you really want to be risky with it, you put it below the inverse, but there is a chance it could wick back into one of these order blocks. So if you do this, you cover yourself, and then guess what? You could actually do this, pardon me. You could go for a 1-to-2. Now, we'll play that out, what happens at price. And we'll speed this up. we tap back into that bullish gap, and what happens? Our 1 to 2 gets hit, right? So what I'm trying to say here, Jimmy Patel, what I'm trying to say here is, to formulate a bias, it comes from understanding that, you have to understand that once the market's rated liquidity and it's filled an imbalance, it's already satisfied the conditions for this run for sell side. So what's it going to do? It's going to target buy side now, and that's basically how the market moves. You pair that with PD arrays and you pair that with macros. So again, these are the notes we've kind of formulated so far, right? This is based on bias, and let's actually add another one here. So what I'm going to say here is you're going to pair your bias with time and price, and that's like the gem. That's the true gem. So time comes first, then price comes second, right? Now, what do I mean by time? I mean using macros, using silver bullet. And let me just mark this out. This is 9:50 a.m. here, and this is 10:10 a.m. here, right? So 9:50 and 10:10. Now, all a macro is, for those that are new, it's just a period of time where the market or the algorithm should do something important. So it's either going to raid liquidity, provide an entry to do something, or it's going to run towards liquidity. This is liquidity. Stop loss, stop loss, stop loss. If you're going short here and you're holding onto a runner, your stop loss goes above there. That's what would happen, right? This is also trend line liquidity. So we're targeting these stop losses. Let's just continue that out for a little bit. And what happens? We take out that liquidity, right? So this point here is pairing bias with time and price. So once we take out sell side, we tap into an imbalance. We're looking immediately for buys. Our bullish bias has come into play at this point, right? That's really, really important. So once that bullish bias has come into play, we're looking for buys. What PD arrays can we enter from? That's our consideration. Once we get that, we try to pair that with time. Cool, we've just entered the silver bullet, or we've entered a macro. Let's enter within that macro. Let's take a long position. So let's assume you did this. Stop loss below that inversion fair value gap candle, right? We project higher. You get that take profit level. Now, personally, if we return to this gap, I'm moving my stop loss to break even. Because if I'm wrong, and if price is going to continue lower, that's the point that it would do it. But why would it do it there? Why would it do it here? This, by the way, is, I think that's a 5-minute SIBI. That's a 5-minute SIBI. And let me just fix this up so you guys can see it. Why would price, if I was wrong, why would it reverse here and not like up here somewhere? I'm going to grab this out too. Now there's two ways to do this, guys. There's two ways to do this. You could use this high, right? And you could get up the 0.618 and the 0.786 levels. That is a premium. That is a premium PD array. You could also do this, like that. Anything above equilibrium, right, is premium. So anything above equilibrium, if you're wrong, that's where price could reverse. That's what I'm trying to say. So essentially, that's how I manage stop losses, right? If I'm entering here, right, and my stop loss was down here, as soon as we get to this gap, which is over a 1-to-1, I move my stop to break even. And guess what? If price comes back down and stops me out, I'm going to reevaluate the market. I'm going to see if I'm still on side with the market. And if I believe I'm still on side, I'll enter again. Doesn't matter, because maybe I just moved it a bit too quick, but I'd rather manage risk, right, than not manage risk and then lose money in the trades. That's kind of how it works, right? So these are 4 things when we're talking about bias, right? And this is just the start. This is just the start. So again, Jimmy, this would be good for you, mate. So I'll upload these pretty much after each masterclass. Just a summary of what we're talking about. So we talked about this London session Friday example. This is the New York session AIM example. And then I want to talk about an example from earlier in the week. So these lines, by the way, guys, these are macros, if you're curious. These are macros that have kind of back tested and forward tested. And I want to go back all the way to this day, which I believe was Wednesday. Okay, cool. Wednesday. Now, this is where it can be really easy, right, to formulate a bias, right? So there are some cases where formulating a bias can be quite easy. Let me just go back. Now, you'd know about this, Jimmy. You'd know about this. So on this particular day, and I'm just going to zoom in a bit. Let me just go replay roughly to about this point right there. Now, on this particular day, on any particular day, I love to see some accumulation at midnight open. And why is that? Does anyone know? Like, we got, what, 14 people watching here. Why would I want to see accumulation at midnight open? What's the significance of this? What does this kind of look like for those that know? Jimmy, Meeks, Michelle. Who knows? What's this kind of look like? What's that look like? What's this look like? What probably should come next as a part of the sequence? Yeah. But power of 3. Power of 3, yeah? PO3. So, right away, right, I think I called this in the Discord too. I was like, right, it looks like the power of 3. Now, you might originally have the right bias. Will it work out exactly how you want it to? Not always. And we'll kind of go through this here as an example. It's a great case study, right? So as soon as I saw this, and by the way, this is all before any key session. We had accumulation and manipulation before we even entered this macro from 150 to 210, which is crazy, right? So what happens here? We get accumulation, we get manipulation. Guess what? At this point, I've got a bullish bias straight away. Without anything else, straight away. As soon as I have accumulation of midnight open and an abrupt move down like that, 90% of the time, it's going to be the power of 3. And why is that? Because again, this tricks people. And what's the market do? There's 2 things the market does. Number 1, it targets swing highs and lows. Again, we've talked about this, swing highs and lows. And number 2, it aims to fill imbalances in the form of fair value gap. So essentially, by price coming down like this abruptly, we've targeted swing lows. So we've taken out liquidity. And what else have we done here? What's this? I'm going to draw it out. I'm going to make it green. What's that, guys? The goat. So this here is your busy, right? It's your bullish gap. So guess what the market's done, guys? Guess what the market's done? We've taken out liquidity. Have we taken out time-based liquidity? Yes. Time-based liquidity being Asian session liquidity. Beautiful. We've tapped into an imbalance. Boom, straight away, I've got a bullish bias. Now, that's not always enough, but the fact that you've got this power of 3, the chances of this not working, extremely rare. Now, what else is supporting price here? What else is supporting price? Well, what's supporting price is that you've got these 2 candles here, which are an order block as well. So you've taken liquidity, you've got a fair value gap, and you've got an order block on the 15-minute time frame that should support price. So it's one of those things. And let me just have a look, Meeks. Let me have a look. Let me have a look here. So what I believe happened here, we'll just play this out. It was a lot more choppy than I anticipated. So I think in the Discord, I was like, oh yeah, power of 3 potentially. And it was just a lot more choppy. I wasn't really expecting it to take that long to reach the accumulation highs. That's, you know, that's the thing. So if you take a long from here, depends where you want to put your stop loss, right? You'd have to have quite a wide stop loss. Probably wouldn't fit my criteria. But what happens here in this first macro, right? So this is 150 to 210. We have an internal rate of liquidity. We tap into this bearish fair value gap. And I'm just going to get rid of this so I can illustrate this, guys. But we tap into this bearish fair value gap here. And then what happens? It looks like this power of 3's failed. It honestly looks like it's failed. Because then we start to respect this bearish PD array. And we start to move lower and lower and lower. But do we take out this low? Right, let's have a bit of a look at what happens here. We get super close. Super close. But we don't take out that low. Now, what this formed was something called SMT. So I know, Jimmy, this would be important for you. And this is from Wednesday, the 7th of Feb. Wednesday, the 7th of Feb. So Jimmy, you know, asking about SMT. Anyone else who wants to know about SMT? SMT is just smart money technique. Now, I want to illustrate this with the chart of ES side by side, right? Side by side. And I want to go back to Wednesday just to show you guys. So where are we? Wednesday. Okay, beautiful, beautiful, beautiful. So I think we are, yeah, cool. So if we get the two charts up, let me just have a look. This low was formed at 130, right? Where's the 130 low? Right here. So this is ES's 130 low, and this is ES's 548 low, right? SMT divergence is occurring there, but even more so between the low at 130 and 250. So where's 250? Roughly about here. Notice how ES has made equal lows, whereas the NASDAQ has made higher lows. Notice that, guys. What that means is the NASDAQ is more bullish because it's failed to take out this low. It doesn't want to have willingness to go any lower. That's another confluence, right? So that's what SMT is called, right? If we were to take out this low, it'd be even better, but that's still SMT. That's equal lows. This here is higher lows. So for this particular trade, right, at this point, let's assume you went long somewhere here. Maybe you got stopped at break even, right? Maybe that happened to you, right? Then at this point, guess what we're entering now? We're entering another macro, and this is probably the best macro to actually use. It's 2:50 a.m. to 3:10 a.m. 3:10 a.m. Now, those that are watching at the moment, can you just put in the chat, what session do you guys trade? Like, does anyone here trade London session? Just put in the chat who trades London session, PM session, AM session, just so I'll get a bit of an idea. I know Jimmy trades London, Meeks, bit of a mix, but anyone else, chuck it in the chat. New York, cool. London baby, New York AM, cool. London, easy. Keep posting it if you haven't done it yet. London, New York PM, New York AM, cool. And where are you guys from? Because I feel like we get a range of different people here. Both, cool. Who's from the UK? Anyone from the UK? Europe? Anyone from Europe at all? Other countries? Australia? America? Because I feel like we've got a wide range of people here, which is great. And we can kind of talk about different sessions. India, there you go. Australia, cool. US, cool. Yeah, it's good. The States. So, yeah, back to this, guys. Africa, cool. South Africa. Yeah, I've got a big audience there, South Africa. A really big audience after checking YouTube, which is cool. Kenya, nice. Nice. The time zones are different everywhere. So even like I know some people who is it who has like 2 a.m. on their time right now? Who's like up like real late right now to watch this? Or really early, I should say. And Trackzillas, that's a great idea. Europe, yeah, cool. I know some people like they're up at like 2 a.m., 3 a.m. watching this, which I appreciate, yeah. Meeks, yeah. It's 5:15 here in the afternoon or night on a Sunday in Australia. 9 a.m, nice and early for you. 5 p.m. on a Sunday, yeah, no, it's not too bad, man. But let's get back into it, right? I appreciate everyone's support too. Like without you guys, there's no YouTube channel. I just started this for myself to keep track of what I'm doing, and people enjoy it, so I'm going to keep doing what I'm doing. Don't worry, it'll keep happening. So just a bit of a recap of what we're talking about. We're talking about bias here, right? And sometimes I'm saying it's easier than other days to find bias. So don't beat yourself up if there's a day in the market where you're like, oh, I don't actually know. And that happens. That's completely fine, right? That was me the other day. When we're sitting in between two ranges, right? Yeah, I might want to favor more towards the lows, but honestly, it's 50-50 in my opinion. On this particular day, it's like 90 to 10. 90% great, 10% probably wrong. And the reason again is because we accumulated at midnight open, we had manipulation to raid liquidity and to fill an imbalance. And then guess what happened here? We had further confluence, we had SMT. And look at what happened here too, guys. We actually had an internal rate of liquidity. So we had SMT hold because that's a swing low, but we had an internal rate of liquidity here. So the market technically has rated more liquidity. Here you've created an inversion fair value gap. We've just entered a macro from 250 all the way to 310. So what happens here, guys? This is an opportunity to go long. As soon as price retraces back, you go long. Where does your stop loss go? Now, notice how this swing low, I talked about this I think in a previous video maybe, but this swing low rate of liquidity, that low should be protected. It should be protected. So my stop loss would go below that low. Where would my take profit be? Well, if you want to go for a 1 to 2, go for that. When would I move my stop loss to break even? I'd grab my Fibonacci. I'd go from this high to that low. When we enter this range, I'd probably get a break even. Now, watch what happens here. Let me just explain this to you. This is one of those examples where, okay, we're at break even now. Maybe you've taken a partial. For example, maybe you're aiming for a 1 to 2. Do you get a 1 to 2? Let's have a look. Let's have a look. You get a 1 to 2, right? Obviously, if you had a high entry up here, then you may not have got a 1 to 2. And let me just kind of play this out and we'll kind of explain what's happening with price. Sri Lanka, nice. Sri Lanka, man, nice. So notice how this inversion fair value gap gets used across time. It gets used across time. And notice how just the wicks are tapping into it once here and once again. Now, for those that know, what starts at 3 o'clock if you trade London session? Like what starts at 3 o'clock? What goes from 3 to 4? What's that termed? I know some people here have different experience, but what's at 3 o'clock? What starts at 3? 3 a.m. in New York Standard Time. Silver bullet, that's it, right? So you've now paired your bias with time with different confluences. This macro, 10 minutes before, 10 minutes after, every single hour, most of the time, not all the time, I wouldn't stretch it that far, but most of the time it's going to do something important. And I always say to people, it does one of three things. It raises liquidity, it creates an entry for you, or it just shows you something important. It actually develops price that maybe later on you can enter. Because guess what, guys? If you miss this opportunity, if you miss this, how else could you execute on this? When price comes back down again, you could go long here. If you don't trust that, if you don't trust this, right? Wait for this fair value gap to get inversed. And now you've got even more confluence because you've got the power of 3. You've got the fact we've rated liquidity, we've tapped into a 15-minute imbalance. You've got SMT, this raid, this inversion fair value gap, right? You didn't take out this swing high with this one, so there's still highs there for the taking. And you could have entered long position from here. Where does your stop loss go? Either below this low, again, or below the candle that creates the inversion fair value gap. So there's always opportunity. There's always opportunity in the market to take a trade. It just depends on what you want to do and how confident you are in the trade. But this one here, I didn't anticipate that all this nonsense would happen. So here's what I'm saying. Like, I had the correct idea. Yeah, we're going to go higher. But did I anticipate this to take so long? No. And if we play it out, what ends up happening is this, right? Have a look. And I've marked it out already. Price taps onto this last down close candle. This down close candle, if I just fix this up, that there is an order block, right? Perfectly taps. And it respects this this bullish gap, wherever that is. The bodies respect that busy. And what happens during this macro, let's just keep playing this out. We end up using that order block to find support. Notice that. We use that order block to find support. The bodies don't close past that, right? Now, if you're curious to see how price behaves in different macros, let's just kind of play this out a bit more. And eventually what happens is this, we absolutely pump to the upside. So yes, we take out our, we take out our highs here, the original accumulation, and you anticipate that, guys. You anticipate that. Like, if you're seeing the power of 3, and again, I went on replay mode, I went back to here. As soon as that happens, you got a bullish bias. As soon as that happens. Me personally, I had a bullish bias. It's one of those things that if you see these signatures in price action, the probability of it working in your favor is extremely, extremely high. So you're looking for these key signatures in price. And again, in these situations, it's much easier to formulate a bias. So in my opinion, you've got different levels of risk when you're talking about biases, right? You've got a low risk bias, a medium risk, and a high risk. A high risk bias is this. This is my opinion, right? Especially if you're trading London session. If you're sitting between buy side and sell side and you're respecting bullish and bearish PD arrays, it's a high risk bias because technically it could go either way, right? The second idea, which is a medium risk bias, is just waiting for price to take liquidity when there's no imbalance below. In this case, there was. The low risk bias is when you have the power of 3 to take out liquidity and fill an imbalance, and you're in a key time frame. Again, time matters. Time really matters, right? It really matters. So on bias, right, those are like the main points that I want to cover. And what I might do here, I might just go to a new chart, and I might go to a higher time frame now, just to kind of have a chat about things. Right, so we'll go to the daily. We'll go to the daily. Why not? Now, before I go any further, does what I've kind of said make sense so far for those that are watching? Just let me know in the chats. Sophie, so Ruben, do you have multiple charts that are open on different time frames, or you just keep changing the time in one chart? Well, have a look at this, right? So I have a lot of charts. What you're saying, yes, in the session I like to have multiple charts. If it's something like really clear, like we just saw, something like this, I don't really necessarily need to have multiple charts. Like if I'm on this and I saw this, I was out for dinner this day actually, but if I saw this, I just switch manually to the 15 minute to look for any imbalances. So the 15 minutes, like the bellwether chart, that's where I find my imbalances, my order blocks. 90% of the time it covers it. Sometimes I might have to go to higher time frames, but it just depends as well what I'm trading off. So right now I'm on a desktop computer, which is quite like, it's a big curved screen. I can fit multiple things. If I'm on my iPad though, it's just enough to fit one screen, and therefore I might need to switch, you know what I mean, between different layouts, right? So yeah, I hope that kind of answers your question. It's up to you. It depends what works best for you, I guess. That's the best way to put it, I reckon. Does that kind of make sense, guys, what I've talked about so far though? So far about like bias, low risk, medium risk, and high risk bias in terms of what's being higher probability versus lower probability and how you can manage the markets? Let me know if that makes sense. Yeah, cool. Let me know in the chat. We got 24 people watching now. Beautiful. Aaron, yes. Meeks, yep. I think Jimmy's left. So now let's go, Sophie, yes, cool. Now let's go on the daily chart. Now there's something ICT posted. It was probably back here, to be honest with you, somewhere around here. And he said something like, if you break all-time highs, remain bullish, right? Join late. Ahmed, that's all right, mate. I'm going to have this recorded and uploaded. So we've just kind of chatted about bias, and we're going to, I'll upload this after this masterclass. So that summarizes what we've done as well. And Aaron, yeah, it's the biggest thing for a lot of traders. You know, that was something I had to work on myself. It's more the way, and I was saying this to my Discord today as well, but separate yourself from the money and just focus on trading. Just focus on trading, simply trading. And if you can trade within macros or key time frames, right, it's even better. And if you have an itch to trade when you shouldn't be trading, trade on demo. Trade on demo. Haralito. So I'm glad you just said that, right? So on the daily chart, until proven otherwise, I'm bullish on a daily. So here's the thing, guys, like in terms of formulating a bias, it's quite easy right now. I'm bullish. The reason for that is because we're at all-time highs. It's quite easy, right? It's quite easy. But let's assume you don't know that, right? And let's assume price action, if we just go to replay, this is like how you do like a daily bias, right? Let's assume price action was like this. And you're like, we're stepping up. There's a market structure shift here. That's a market structure shift. You might see that. There's a breaker block and a fair value gap. This is a unicorn on the daily. Now, this candle, this closure completely violates that. It violates that, right? That there becomes the next straw on liquidity. It has to be, because you've now violated this breaker block and this SIBI. You've now created an inversion fair value gap. That there has to be the next straw on liquidity, right? So you play that out. Obviously, we take out that high. Now, if we look at where price is at the moment, you said my name right. Yeah. Yeah, so at the moment, if you have a look at where price is, we've created all these highs. Now, what's interesting here too, look at this. Look at this right here. Right there. Look at that. Now, yeah, Joe, beautiful question, man. Beautiful question. We'll do that in probably about 5 minutes. In about 5 minutes. That's a very good question. We'll go through that. Now, does anyone know what that's called? Like, let me just get rid of this. What is that called? It's a type of PD array. It's a bit of an advanced one. Who knows what that's called? Where like just the wicks overlap. It's not a fair value gap. It's very similar though. Who knows the name of that PD? Yeah, volume imbalance. Now, personally, I haven't seen this since I've started trading futures. Volume imbalances I've seen, but we've actually got an overlapping of volume imbalances, which is quite interesting. It's very interesting with price action, right? So we had this volume imbalance here initially, right? And then price, right, eventually closed above that volume imbalance. And then we traded back into that volume imbalance right here. So it's kind of like an inversion volume imbalance. So the funny thing is, ICT has mentioned before that volume imbalances, fair value gaps, breaker blocks, order blocks, whatever it is, they can all be used as inverse PD arrays. Inverse PD arrays. They can be, right? And this is something that, you know, I'm going to do more research on and find more examples of. In my Discord, you already know, right? We've got probably, I think there's about 25-ish. Yeah, that's what I'm thinking, right? Like a balanced price range. But I think in my Discord, there's about 25 ICT concepts. I think, right? All of these, right? So essentially what I'm trying to do is add on to that. And what I'll be adding on to that, there's a few more things I want to add on as well. But that will be one of them. Right, I'm going to continue to forward test this and back test this. Obviously not on the daily time frame, but maybe on the 5 minute, the 1 minute, just to see how price reacts. But again, this is like a volume imbalance that's been inversed and then traded back into. So on a daily time frame, guys, what I want price to do, if we come down, if we remain bullish, I want it to respect the halfway point of this. Because if I treat it like a BPR, then the body should respect the halfway point of this, right? At this stage, what's close by in terms of PD arrays? If I grab my Fibonacci and I go from this high, from that high to that low, and I just mark out my equilibrium, I'm looking for things that are in a level of discount if price were to come down, right? If price were to come down. And I will do that for you now. And I'll just do it for this one right here. There you go, right? And what I'll do, I'll just get rid of that. There you go, right? So this here is the dealing range that we're currently sitting in, right? From the swing low to the swing high, almost that we formed. We haven't technically formed the swing high, but we're just taking the last week's range plus this swing low. There's a PD array that rests below equilibrium as well. And yes, I will be giving the PDF away. So this, I'll upload this a bit later on after this video. But again, I want to see some more price action. So essentially what I'm trying to say here is, if we form, let me just get the path up. If we form a swing high, then maybe we retrace, but we haven't even formed a swing high yet, right? But just keep that in mind, right? We're bullish until proven otherwise. To remain bullish, I want to see price close above the 0.5 level. If not, then we head lower. But again, we've been so bullish. Look how bullish we've been. Look how bullish we've been all the way since October, up and up and up and up and up. And this so-called market structure shift, right, was invalidated. So we've got to be really mindful that price at the moment is respecting all of these bullish PD arrays. So what I mean by that is this: you can still take shorts. Shorts are still permissible, right? But if you're a longer term trader, I'd be looking more for longs. So I'd be like fading these short moves and looking for longs. So for example, if you have a look here, if you could have taken a long from around this position, you've returned to a busy, you're respecting that busy and you push out of it, that would have been a good position to take. But me personally, I don't trade the daily. Yeah, I don't trade the daily. So in the chat here, a few things that are probably important to point out here is this, right? I'm bullish on the daily. Does that mean I'm not taking shorts? No way. I'm gonna take shorts, 100%. Like if I just show you some of this stuff here, right? So where are we? This one here, I'm taking shorts. I'm taking shorts. There's no way I'm not going to be taking shorts just because we're bullish bias. But because we're trading intraday, a bullish bias on the daily time frame doesn't necessarily mean I can't take shorts on a 1 minute time frame, if that makes sense. So for me, this is just food for thought. If price starts trading close to this 0.5 level, then it's more important to me. Then I want to zoom in and see how it reacts there. But until that point, I'm bullish on a higher time frame. That's kind of what I think. Yeah. Does that kind of make sense, guys? Let me know in the chat. And if that makes sense, I'll go into what you're asking me there, Joe. So let me know. Cool. So let's talk about low resistance. I think that's what you're asking me. Low resistance and high resistance. Yeah, okay. Now the best way to illustrate this is to show you what price does. And I might just actually get a fresh chart. There's too much going on, right? And I'm just going to look through the week. We'll go back to the daily or the minute time frame here. Now, what is a low resistance liquidity run? How do you know it's low resistance? Well, the way I like to teach this quite simply is if there's trend line liquidity, it's low resistance. And let me just kind of illustrate that here. I'm going to mark out a few things. This swing low, this swing low, this swing low, these areas right here. Now you might go, oh, well, this wick took it out, but look where it closed. The bodies of the candles tell the story. The wicks do the damage. So for me, the bodies have closed here. I'm still counting this as trend line liquidity, right? And what I mean by that is there'd be retail traders out there that would draw this trend line and say, oh, we've bounced off this so many times. I'm going to go long right here. They're going to go long right here. They make a little bit of money. They're still holding on. What's the market do? Boom, straight down. Look at the aggressiveness at which we actually trade down past these lows. And once we've taken out the trend line liquidity, look at what the market does, right? So a low resistance liquidity run is essentially where in the upwards trend, all these swing lows have not been taken out. This one's an exception, but for the majority that haven't been taken out. The market shows you its low resistance liquidity by actually trading down like this. But if you can draw a trend line, it's called like phantom liquidity. It's called like phantom liquidity. So that's one example, right? Trend line liquidity, which I love, right? I love trend line liquidity. Another example is here. This is like a bullish example. So this, see all these? See all that? Look at that. Look at that. Price is like tapping. It's tickling this zone. That there is all trend line liquidity for me. It's all trend line liquidity. And the market trades through that quite aggressively, right? There's a few more examples, I believe, from London session as well, which we can talk through. All of this is trend line liquidity too. So see this? Really close, narrow range liquidity. That's during Asian session. And look how aggressively the price smacks through that as well. So trend line liquidity is, I guess, the key for a low resistance liquidity run, right? And if you can frame trades based on that, then you're doing good. And I'll show you more examples, right? I'll show you more examples. Here's another example, right? Relative equal highs, trend line liquidity forming right here. Let me just get this up. That's all trend line liquidity. We smack through it. This is all trend line liquidity. We smack through it aggressively, then we reverse. So you'll start to see these patterns in the market, and the more trend line liquidity you have, the better it is, in my opinion. So when you have a sustained increase like this, 1, 2, 3, 4, then the market's going to really smack that up, and it targets that, right? I'm just going to get some more examples for you. This one is a great example too. So look at this, right? Look at what price does here. Look at all this trend line liquidity. Look at that. Crazy amounts of trend line liquidity. And the market, what it's doing, and you don't really, like, I can zoom in a bit, but I want to draw this out for you. Look at how much accumulation is in this zone. Look at this. Even just moving up here. Look at that. That's all trend line liquidity. And what's the market do? Boom, smack it out. We take it out, right? The market loves these types of liquidity points. And here's another example for you, just food for thought. That there's a trend line people would draw. What's the market do? Smack through it. When does the market smack through it? if I just mark this out, where's the start of silver bullet? 3 o'clock to 4 o'clock. That's silver bullet. When's the market take it out? Silver bullet. So I love trend on liquidity. That's low resistance liquidity. That's low resistance liquidity. And here's another great example, right? I know I've gone through quite a bit, but you can re-watch this too, right? Look at that. Beautiful. And look how the market trades through it. Bang, straight through. And that's a news event as well, right? So use trend on liquidity as a target. Use it as a target. When can you expect it to get taken out? Well, you want to ideally be trading during a key time frame. So for example here, this is the silver bullet, right? So you could take a silver bullet trade to go long, right? This inversion fair value gap, price returns to that, and then also returns to this bullish gap here. And so you want to use key time frames, Joe. And I'm gonna answer some of these questions here as well. So the PDF, yes. I'll be giving that out after the masterclass. That's gonna happen 100%. But yeah, does that kind of make sense, Joe? Like that's low resistance liquidity, and then what you want to do is like try to frame your trades on targeting that. So I would consider this back on the topic of bias, right? I would consider this the same as like the power of 3. It holds the same amount of weight, in my opinion, the same amount of weight, because there's accumulation here. There's so many stop losses above these highs, so many stop losses, and the market loves to target those types of things. So that's kind of what I see there, if that makes sense. Yeah, if you've got any other questions, let me know. But yeah, that's the trend on liquidity. Now, Haralito, you asked me, do you only trade in macro times? The short answer, no. The more detailed answer is I prefer to trade just before, during, or just after a macro. And I'm glad you mentioned that, because that now is the next topic we're going to kind of discuss, right? We've kind of gone into a little bit here, but I want to discuss it a little bit more. We do this every masterclass, but it's something that's really important, you know what I mean? And we'll go through it now, right? We'll go through it now. So the last point here, and then I'll be open to whatever questions you guys have for me, apart from what you've already answered, that's completely fine. But keep this in mind. This is some sauce right here. That's some sauce. Just that point. So these are the 3 ways, Haralito, right? This is how I use macros. Either I enter before the macro, anticipating that the macro will deliver. I enter during the macro if there's a setup that forms. Or I enter after the macro has actually happened, and once it's rained on liquidity. That's kind of what I do, yeah? So there's 3 ways I use macros. I've got some photos there. But why not just hop into the charts? Now, I'm going to do a mix of things. I'm going to get a new chart, right? And I'm going to do a mix of things. I'm going to start from just Friday, and we'll just talk through what happened, AM session, PM session, and then I'm going to go back because I've already charted it out, and we can kind of talk about it in that regard, right? So 10 minutes before, 10 minutes after every single hour, there's a macro. This is something that I called in the Discord. Meeks, are you still here? Are you still here, Meeks? And GPC, yeah. GPC, this is Masterclass number 3. Masterclass number 3. Discord link of our traditional. Right. I'll change that. When I upload it, I'll change it. Thanks for that. Yeah, Masterclass number 3 today. Discord link I'll put in my community tab later on, right? If you guys want to look at that. But Meeks, I think you remember this. This is from Friday, and in the Discord, I mean, you've probably already seen this, right? But this is what it looks like, guys. If you're curious, right? I'm not hiding anything from you. This is what it looks like. We talk about different ICT concepts. We talk about things here, and when I see something, I call it out, right? That's just how I do it. And essentially, this was the trade right here. Now that's the breaker block, and we're going to go through that in this example, right? Because this talks about macros and also about breaker blocks. So 10 minutes before, 10 minutes after every single hour, there is a macro. There's a macro, right? So let me just draw this out. So if you're back testing, guys, just start from from the Friday. Depends what session you trade. I'm starting with PM session, right? But you can start with whatever session you want to trade. That's completely fine. So there's the macro. Let me just go back to the 1 minute time frame. So this time frame here is 250. So that's 250 PM, and then this one here is 310. So if you're back testing the macros, this is what you do. Now, what I see here, this is a breaker block, right? It's easier to see on a 30-second time frame. I'm just going to go through this quickly because I've got another video already on this. But this is a breaker block. Let me just draw this out. That's a breaker block. So you've got a high, a low, a higher high, and a lower low. That creates a market structure shift. And it's those last down close candles. There's your breaker block. Now, in that breaker block, you've also got a bearish fair value gap, which I'm going to mark out right here. And these two up close candles are an order block. So you've got three. Yeah, mix. That's all right. It happens. You've got 3 PD arrays to enter from. Now, if you're still watching this, and a lot of people might skip parts, it's fine. Do what you got to do, right? But there's little things I'll drop along the way. Now, someone asked me this previously, and they said to me, they go, how do you know that PM session is going to be good? How do you know that PM session is going to be good? Like, I find that a lot of the time it's going to be poor or pretty crappy, right? But for me, if AM session and the lunch hour are pretty average, well, guess what? The PM session is probably going to be good. And if AM session and lunch hour have gone up, I'm expecting a reversal at the end of the PM session, which is exactly why this trade was also favorable. So again, we've got macros here. Now, Trackzilla's, I don't necessarily trade live. A lot of people ask me to do that. I'm thinking of doing it, either for YouTube or for the Discord. I know some of the guys in there have been keen for me to do it. In the Discord, I post my analysis. So I'll post stuff live in the moment. It's one of those things, just depends what I'm using to trade, man. So if I'm on the iPad, it's tricky. On the Discord, I could go live. But right now I'm using OBS, so I could only do it if I have the desktop access. So that's the only thing. And GPC, yes, I'm going to upload this after it is finished. So usually this goes for about an hour and a half, 2 hours. We'll see how we go, yeah? But when we're talking about macros, guys, 250 to 310, can everyone see, and I'm just going to leave this on the screen for a second. I know some people have, a lot of experience. Some people are, just starting out. But can everyone see at least that there is an entry during this macro to go short from a bearish fair value gap? Can everyone see that? There's an entry between 250 and 310 to go short from a SIBI or from a bearish fair value gap. Cool. So this is the first example, right, of how macros can be used. You can enter Aaron, cool. Aaron, yep. Joe, cool. Yes, sir. You can enter during a macro. And don't believe me. Don't believe me, right? Back test it and forward test it. I had a guy that I've been talking to, one of my mates who's trading, and he started doing this himself, back testing and forward testing, right? And he's surprised, right? It should open your eyes. So this is something where you can rely on it most of the time. One of my mates I talked to, he reckons it's about 70%. 60 to 70% without any other confluences, just relying solely on the macro, which is pretty good with no other confluences. So imagine once you have confluences, and if you can utilize these macros to your advantage, really, really good stuff. So here's the macro, right? That's the first macro. Now, here's the thing, guys. Some macros do nothing, and here's an example of one that does nothing. Let me just go back to the 1 minute time frame. Sometimes they do nothing in the sense that they're not going to give you an entry to do anything. So 150 to 210. Now, if you're watching this, guess what that means. How you going, mate? Ahmed. Well, Ahmed, here's the thing, right? Ahmed, yeah, you asked the question. In this case here, right? I was on the 30-second time frame. At this point, I believe we were at all-time highs, right? So in this case, and this might break some rules that you've learned, that's okay. you don't always need the grab of liquidity if you use time and other confluences and it makes sense. And it's something I'm going to expand on in the future. Ideally, you want to see a rate of liquidity, but at this point, like technically, if you go on the 30-second time frame, technically, you formed a swing high here and you've taken that out. You formed a swing high here, you've taken that out. But in this case, we're relying on time, and 3 PD arrays, breaker block, SIBI, order block. And relying on the fact that there's all this accumulation here, which, Joe, what did I say that was? What's this, Joe? Joe can answer this one. What's that? Why is that important? Why would I have confidence that we're at least going to, go down here? Exactly, trend line liquidity. So to put it simply, Ahmed, when you're first starting, always look for a RAID, a market structure shift and return. As you progress, based on different confluences, you can look for different things. That's just kind of what I'm illustrating here. And I'm illustrating the importance of using macros right here. So by the way, guys, if you want to share something with me, just briefly, I'm going to post this in the chat. You can send me an email, right? It's fullviewtradingaustralia@gmail.com. If you want me to go through Euro macros or something like that, private message me or send me an email. We can kind of have a chat about that in private, or I can go through it at the end as well. That's completely fine. But yeah, send me an email or leave me a message here. Send me something on TikTok if you got me on TikTok too, and I'll get back to you. Any questions about the Discord, charts, macros, whatever, go for it. So yeah, this macro delivers. Now, that's a good example. Now, you might go, oh, well, it didn't even take out the trend on liquidity. Right, we did take out some of it. Right, so I would like to see price go down there and take that out. That would be really nice. Now, if we go back in time, I talked about how this macro did nothing. Let's go back to the AM session, because the AM session and PM session are where people trade. The lunch hour usually is avoidable for most people, right? But, let's go back here. Let's go back here and see what happens. So if you trade the AM session, this would be important. Trackzillers, I appreciate it. Well, believe it or not, I'm actually a teacher in real life. So maybe that's where it comes from. But I'm passionate about this, and if I can help people, that's all that matters. Because for me personally, when I started, it was tricky. It was tricky. If I could have someone going through this, I would have loved it. You know what I mean? So I try to give back where I can, and obviously I've got the Discord and stuff that's paid, but I've got free resources too. That's very important for me as well. So it's still going to be here. I still love making YouTube videos and TikTok videos. So all good, all good. But let's go to the 1 minute time frame. Let's go to the macro here. Right, so let's go from 950 to 1010. So let's go 950 to 1010. Now, what I want you guys to do is I'm going to mark out this 950 to 1010. We've actually rated liquidity here, which is a London session liquidity. That's all trend line liquidity. We talked about that briefly before, Joe. Now, do you guys see an entry during that macro? Let me know, because I do. Who else sees an entry? Thanks, Joe. Appreciate it. Yeah, for anyone that's watching for the first time, right, if you're liking what you see, I'm not asking for money. That's completely optional. If you're on the Discord, it's there. I'll post the link later. But if you could like this video, if you follow me on socials, I've got TikTok, obviously YouTube, and I've started a free Telegram and Twitter as well. That's free. Takes no money, takes only a little bit of time, but I appreciate that. So I appreciate that, Joe. Sophie, do you ever take continuation of the trend? Well, continuation of the trend trades are something I'm still forward testing and back testing. So personally, I prefer taking these reversals because I know they happen usually during macros, and I know time's important. So if I can base things on time, that's the most important thing for me. I'm currently working on a model. It's still in the process. I've been going for quite a few weeks, 3 to 4 weeks, of a trend continuation model. Once I've kind of got that, I've got the basics and the extremes of that, then I will post that for you guys too when I come up with that. So unicorn, yep, I see it. 1 hour busy, bullish breaker block, SIBI. Will the macro entry be the first BPR fair value gap? Yeah, there's a lot of things going on here, right? But you guys are pretty much all right. So Look what happened here. We took out, and we talked about this, we took out liquidity. We took out London liquidity. That means we've taken out time-based liquidity. Automatically, I've got a bullish bias because I want to target this trend on liquidity and any imbalance through here. Beautiful. Now, let's start with the easiest of the PD arrays. There's a bullish fair value gap right here, and I'm assuming most people can see that. That's your bullish fair value gap. That's your busy. Right? A couple people kind of mentioned that. So even if you had no understanding of breakers or inversions, you could take a long position right from here. Now, you don't have to enter in the macro, and this is what I'm kind of talking about. If you think the macro is going to do something important, which it should, you could have entered right here. You could have entered right here. If you want to wait for the macro, you can do it, but it doesn't always happen during the macro. You could get an entry just before or just after, I've realized, give or take, 5 or so minutes. That's usually what happens. So let's say you use the busy or the bullish fair value gap. Busy, busy, busy. Stop loss can either go below this low. Like, there's many ways to manage risk, guys. You can do below this low if you want to, and you can target, your 1 to 2. That's fine. If you want to get your 1 to 2 quicker, and again, don't listen to this because I'm telling you to say it or to do it. Sorry, I'm not a financial advisor. This is just what I personally do. So back test this and forward test this. For me, I don't want to have a stop loss that big, 25. Nah. So what I'm going to do is I'm going to put my stop loss below this candle, which actually forms an inversion fair value gap, which I'm going to draw out here in orangey yellow. So that's kind of what I'm doing. Yeah. So this here is, and a couple people mentioned this. This here is your inversion fair value gap, right? This here is your bullish fair value gap. That's your busy. Now, some people see this as a breaker as well. Is that what you guys are talking about? This candle here. Just let me know. Who was it that said a grand tour? You were here last time. Good to see you. Yeah, so you could see that as a breaker block as well. And if you saw those three things, right, then guess what? That there is a 3 PD array supported trade, which means it should be quite strong because you got 3 PD arrays at supporting price, right? What that means then, if you enter a long position, say from here, and you put your stop loss below this inversion fair value gap candle, you would have to disrespect a breaker, a busy, and an inversion. And if you disrespect 3 PD arrays, your stop loss is coming next. You know what I mean? That's just what it is. The chance of 3 PD arrays getting disrespected and price coming down here and then closing here and you're not getting stopped out, you're probably getting stopped out, and you just got to accept it. Right? That's just what happens. Right? So sometimes you get all these PD arrays lining up and it won't work out. But in this case, where you see multiple stacked PD arrays and you've got a clear draw on liquidity and you've taken out liquidity, that's like a high probability setup, yeah. And yeah, that's the thing, grand tour. When you've got multiple PD arrays, it makes your life so much easier. So that's a beautiful, beautiful trade. So with this, if you want on a 1 to 2, beautiful. If you want to hold runners, beautiful. And I'm sure there would have been some people that would have held to this high right here with this long wick. They would have held to that swing high there. Now, if you look at the next macro, nothing really happens here. Nothing really happens in this macro. So if we go from 1050, right? So if we have a look, 1050 all the way to 1110 here, nothing really happens in that macro. But I mean, if you like to scalp, you could see this maybe as a little 3 drives pattern, 1, 2, 3, and maybe you justify, going for a short from this fair value gap here, if one even exists. And I don't think it does. So really, this trade here wouldn't have been a high probability trade. Yeah, it would have probably worked out. You could have gone short maybe from here using what happened during that macro, and you could have gone short, to target what you need to. But it depends on your trading style, guys. That's the thing. So this here may be an example where you're scalping. So let me just mark out 1110. The macro doesn't do anything, but you wait a little bit longer. You see a market structure shift below that swing low. There's a fair value gap that sits, within a level of premium. You enter from there, right? It's still viable, but Do you have as many PD arrays supporting price? Not really, right? So you could still do that, and you could probably still get a 1 to 2, but it just depends on your trading style, guys. But that's an example where the macro won't deliver an entry, but maybe slightly after it'll deliver an entry for you. Does that kind of make sense? And again, I'm just going through all sessions, all kind of time frames, because I know people trade different sessions, you know what I mean? So it's an important thing. And what I want to do, I just want to go back, because we already talked about some of this stuff. I just want to keep scrolling back. We've talked about some of the other macros previously in the video, but I just want to keep going back. This is stuff, this is new territory, right, for me here. Now I'm going to pick on you again. Are you still here, Joe? Are you still here? This is a beautiful price action, by the way. Beautiful price action. Let me know if you're still here. And we're talking about PD arrays now. We're talking about macros, quite a few things. So we're up to the end. Cool. Joe, you know that's trend line liquidity, right? Now, here's an even better one for you. Here's a better one for you, and for everyone listening too. When you've got trend line liquidity and you've got an imbalance or some kind of PD array to target above that, you're in good hands. Now, what I'd call that, you could call it the gap, the new day opening gap. I just like to call that like a liquidity void. Right there. See, there's an actual gap between the two candles. It's like a liquidity void. Now, not always, but if it frames the trade, it frames the trade. We've got trend line liquidity and we've got a liquidity void to target. Now, we're talking about macros. So we're talking about PD arrays. That there is a liquidity void. And now in terms of talking about macros to suit this liquidity void, remember I told you guys the one that's from 250 if you trade London session, the one that's from 250 to 310. That's probably the best one because it lines up with silver bullet, right? Now, this macro, it seems like it does nothing. It seems like it does nothing, right? We raid liquidity, so I'm going to mark some things out. We raid liquidity. This is an example of where the macro doesn't do anything, but just after it does something. So again, price is algorithmic, but there is room for error sometimes. And in this example here, the macro, and I'm going to draw this out, we've got 2:50 a.m. right here, and we've got 3:10 a.m. So I'm watching the charts, right, at this point. I'm watching the charts, and let me just change that to AM. And I'm thinking, all right, what's that macro done? I want to go long. We're in silver bullet now. And I'll just fix that. We're in silver bullet now. I want to go long. Okay. We know that's the macro. So we know those 2 points of the macro. Who sees an entry to go long just after the macro? Who sees an entry to go long just after the macro? Let me just get rid of these lines and I'll mark this out with a rectangle like this. So that's the macro. Who sees an entry to go long just after this point? Let me know in the chat. So we've had a rate of liquidity, another rate of liquidity here. Let me know. And if you're going to post something, post it. It's great. If not, I'll go through it here. Volume and balance, yeah. Yep, beautiful. So it's great to be able to illustrate different PD arrays for you guys. And I mean, I just went to a random day, right? But things pop up, right? This is probably, what day is this? This is from 26th of Jan. So if you want to look at this, 26th of January, good example to have a look at. Volume and balance. Now, technically there's a market structure shift, right? There's swing highs here, we break above that, there's a shift in structure. Can everyone see the inversion fair value gap? There's actually 2 inversion fair value gaps here. Yeah, so there's actually 2. There's this one down here that you inverse, that's an inversion, I'll just draw that out in time. And there's also this one up here, like that, and we inverse that right there. Now, that inversion fair value gap, we'll just get rid of this one for now, lines up with that volume imbalance. Can everyone see that? So it lines up with that volume imbalance. So now I've got 2 PD arrays supporting price. The third PD array is actually this candle here. This candle is an order block. So I still have 3 PD arrays supporting price. So if you wanted to go for a long position, this would be your silver bullet entry. We'll talk about another entry too, right? So long position from here, as soon as we tap into the volume imbalance. Now, let me just get up my Fibonacci, this low to this high, and let me extend that across. Notice that that volume imbalance and that inversion fair value gap rest below this 0.5 line. That means it's also a further confluence to enter the actual trade. Dark mode. I can change it. So I've thought about doing this, the canvas. I can make it a bit darker like this. It is pretty bright, but we'll leave it like this. Hopefully that helps you. I like the bright. I don't know, keeps me awake, keeps me focused. But yeah, we can see obviously this inversion and this volume imbalance sit within a level of discount. I'm going to just call this VI for volume imbalance right there. Right, so VI for volume imbalance, and we'll move that to the right. And then this, as you guys mentioned, was the inversion fair value gap. Plus you've got this candle, which is your order block. You could use the wick, you can use the body, whatever kind of works for you, right? And that's it, yeah. Good to see ya, Pepe. Good to see ya. So many confluences. So there's 2 things to talk about here. The entry, obviously, yeah, you can go long from here. Where does your stop loss go? Now, here's the thing about stop losses, guys. If you put your stop below this low, well, guess what? You're not getting a 1 to 2. If you put your stop loss below the next swing low, guess what? You are getting a 1 to 2. So this candle here, let me just zoom in. This candle here, that is a swing low. The reason why that's a swing low is because that candle's low is lower than this one's and lower than this one. So it forms a swing low. That there is technically could be a swing low too. But again, if we disrespect the inversion, the volume imbalance, and the order block, well, I'm probably wrong, right? I'm probably wrong. And you can see it does do that here. And you might be thinking, well, what's going on there? Here's an example of where you might have to execute on the same trade if you still have that same bias, right? But again, this would have been the trade to take a long position, and you would have been done within like what, 322, like 15 minutes. So most of my trades like between 15 to maybe 30 minutes. If I've got a runner, yeah, maybe it goes towards the hour, but it gets boring after a certain point, you know what I mean? I prefer to be in, I prefer to be out. You know, if I don't have to be looking at the markets, I don't want to be, because it reduces the time you need to be on the markets. And the more you spend on the market, it's like the casino analogy. The more time you spend in there, the more you're going to lose, right? Once you make the money, you get out of there. That's it. You can demo, you can tape read, whatever, but in terms of on a real account, get out of there. That's my opinion. I treated it as a unicorn, yeah, and took out the closed candle as a breaker block. Yeah, cool, man. Yeah, I like that analogy too. And track zealers, that's what it is. That's exactly what it is. Because I've been there, you've been there, where, you know, we're all human, where there's a couple of things that happen. You know what I mean? You're watching the market for so long, you just want to take a trade, and this was especially in the early days. And because you've been on the market so long, you just take a silly trade. Or you take a trade, you're not satisfied with the win, so you take another one that you shouldn't, and you take a loss, and now you're down for the day. So once you make your target, leave it. Even if it's a little bit, leave it. Especially when you first start, leave it, because taking anything from the market is better than not taking anything at all. That's just my opinion. So that's my advice. Now, this is the first macro we talked about. I'm going to put that back up here, 250 all the way to 310. So that macro didn't give us an entry, but it gave us an entry just after the macro. Let's have a look at the next macro here, guys. So 350 is right here to 410. Where are we? 409, 410. What's this macro doing? It's rating liquidity. So it's rating this sell side liquidity, and it's giving me a potential inversion fair value gap play, which I like. Now, you know what I like about this one, guys, for another potential trade? Look at these two highs here. They're relative equal highs. especially the bodies, like the relatively equal highs. And we've also still got this trend line liquidity that's formed. And like we talked about before, Joe, we still haven't taken out this. That's still a drawn liquidity. And this is how you know it's a low resistance liquidity run. Look at the aggressiveness, straight up. We take out that liquidity, right? So that's how you know it's a low resistance liquidity run. We did talk about a little bit about that before, but that's kind of what it is. Now here's the other opportunity I see. And this is kind of like a trend continuation because the trend's already been, we already started the uptrend, but here you've got a rate of internal liquidity here. You've got an inversion fair value gap, and you've got a busy here that you can enter from, right? Plus you got this inversion fair value gap that was used. We can use that again if we want to, but essentially this could have been a second trade if you missed out, right? And you could have got an entry here to go long, for example, at a level of discount, right? So you probably have to enter here. Stop loss would now have to go below this low, bit of a wider one, but you still get what you need to get. So macros are your friend. Macros are your friend, guys. They really are your friend. In this example, 450 to 510, what does that do? We tap back onto this order block. And again, we haven't taken out the trend on liquidity. So here's actually an important point. For those that are still watching or those that have just joined, this is something good for your notes. If we haven't taken out the drawn liquidity, I wouldn't be trying to look for a reversal. And here's like a perfect example. The drawn liquidity, or technically, is all these highs here in the liquidity void. As soon as I saw that, like this is like an Asian session, I was like, yeah, we're going to take that out. We're definitely going to go up there because we're forming this trend on liquidity. We've got a liquidity void above. The market targets two things, imbalances and also liquidity points. So at this point, why wouldn't I go short from here? I'll tell you why. If I mark out Asian buy side, which these points are all Asian buy side liquidity points, that's your highest point of Asian buy side, right? We haven't even taken that out yet. So I would not be wanting to go short. I would not be saying, okay, well, that's your market structure shift, that's your fair value gap, that's your breaker. No, because again, this is where bias comes into it. I have a larger bias that we're going to actually reach the liquidity void and take out the Asian buy side liquidity points. So same thing with this, guys. Like here, even this, to me, that's not a big enough run above the buy side liquidity point. It's not. And especially, we still got the liquidity void. We still got it. So if I draw this out, the next macro as well, and we'll talk through both of these, because again, sometimes they're not going to give you entries, sometimes they might as like a trend continuation. So we'll talk about that. But this first macro here, from 450 to 510, all we're doing is we're tapping onto this order block. And look at this, right? Look at this. You could go for a trend continuation here. You're forming an inversion fair value gap right here. You're forming a bullish fair value gap right here. And let me just draw this out in green. And you could go long, right? You could go long, right? But if you do this, look what happens. What do you get? You might take one partial, then you're probably going to break even. Depends on what you want to do. If you leave your stop loss, obviously you could grab it. But let's say you took a loss here. You're taking trend continuations. Because I know someone asked about that. Then here's what you could do. Wait for the next macro. You know that this is the drawn liquidity, right? We haven't reached that yet. What's this next macro do? This next macro, quite interestingly, raids liquidity. This order block, oh, what do we do there? We tap onto that. So we raid liquidity during that macro. Then I'm looking for an entry to go long. Okay, we've got a bearish gap and a volume imbalance right here. Right, there's my opportunity to go long as soon as the candle closes above. Like this. Stop loss, where is it going to be? Below this swing low, because that swing low took out liquidity. Where do I target? I target this high at minimum because there's trend line liquidity, or I hold onto a runner for this volume imbalance or this liquidity void, sorry. So that's a trend continuation trade that you can take. It still requires a rate of liquidity, a tap onto an order block or some kind of PD array, and then a respect or disrespect of a bearish fair value gap there. So that's an example of a trend continuation kind of model. But after this, we're kind of outside any key time frame here. So again, would I be trading then? No, right? So that's kind of macros for you guys. Now, I want to do a little bit more, and just let me know who wants a little bit more for macros, or who has any questions. Because if you have any questions, send them through now. Send them through now, and we can actually go through some of you guys' questions. Any question regarding trading? And I'm happy to help. Yeah, there's a lot of information here, right? But it's one of those things. So my advice is, rewatch this if you want to. Go back and look at the charts as well. Keep going. Okay, cool. I love it, if you can't tell. I love looking at the markets. It's just, you got to enjoy it. You have to, because if you're spending time looking at it, I mean, if you don't love it, you're in trouble. Yeah. We'll go to the AM session, right? Macro. Oh, I love macros. So here we go, 9:50. And I don't trade the AM session anymore. A lot of people have been asking me. I don't trade it anymore because in Australia it's like 2 to 3 a.m. It's too much. It's too much for me. I used to go to bed at 10 o'clock, wake up at 1, get ready for the 1:30 open. Too hard. And then I have to work as well the next day. Go to bed at like 4 because I couldn't sleep after trading. So it's one of those things. Okay, so here we go. What happens here during this macro? All right, we raid external liquidity. This swing low right here. We also raid an internal point of liquidity right there. Right, so we've got a raid. I might just simplify it to being this. Yeah, we'll track Zillas mainly on the 1 minute. I execute on the 1 minute. Rarely have I done anything higher than the 4 or the 3. Like, I've done probably 3 trades on the 5 minute. Like, very rarely. The only time I'd probably go on a higher time frame is if, like, either I want more confirmation, so I enter a small position, or like I'm outside of a key time frame. But most of the time now, like 99% of the time, I'm trading around macros. That's what I want to focus on, and it's the 1 minute. But here's the thing: I implement PD arrays from the 2, the 3, the 4, the 5, the 15 on a 1 minute chart, and then execute on the 1 minute, if that makes sense. So yeah. Lucky I'm based in Western Australia. Well, Western Australia is like a couple hours behind. I'm from Sydney, or ahead. What are you guys there? I only trade the AM session because I trade full time. Yeah, that's fair enough. I mean, to be honest with you, I've traded every session. I've tried Asian, London, New York Forex Kill Zone. I've traded, AM session, PM session. They all have opportunities. They all have opportunities. It just depends what suits your lifestyle. That's my opinion. Same with Forex and indices. I prefer indices, but yeah, they all have opportunities. So again, before I point this out, this is the macro from 9:50 to 10:10. I can see like a very beautiful entry. Can anyone see it as well? Just after the macro, or during the macro, actually. During the macro. Can everyone see the entry to go long? Let me know. Because as much as I want to teach, teaching's also, it's good to get you guys' feedback. So can everyone see the long entry? Fair value gap, how to capture the trend, inversion, fair value gap, and busy. Yep. Beautiful, busy, beautiful. What are your favorite go-to PD arrays? Okay, cool, let's talk about it. What you're seeing here is what you're seeing here is like a picture-perfect example. It's like, yeah, BPR, a balanced price range. So here's the thing. A balanced price range technically creates an inversion fair value gap. But what I like about this one is that you've got a down close candle, you've got like the bottom candle, and the next one is the one that closes the gap. So you can see here, right, technically there's a gap between the bottom of this candle and the top of this one. But notice here, right, how yes, we close above it here, but there's all this stuff in between. Whereas in this example, we've got a down close candle, one in between, and the next one immediately breaks past, and with one candle we close the gap, or we balance out the price range. So this here at the moment was a sell side imbalance, buy side inefficiency. So it was inefficient in buyers, and then the buyers came back in supposedly and smacked through and filled that imbalance. So now it's efficiently delivered, or the price range is balanced. So that there becomes a BPR, but technically it creates an inversion fair value gap. I hope that kind of makes sense. Right? So that's your balanced price range. Now, here's the lovely thing, right? Whenever there's a balanced price range, ideally, here's maybe something for your notes. And I'm going to write this down so it gets captured too if people are watching this. For a BPR, ideally, you want price to respect the consequent encroachment or the halfway point or the 50% level, right? So if I do the Fibonacci and I just get this BPR out, you want the bodies to respect the halfway point. And do the bodies respect the halfway point? They do, right? And this is the beauty. This is the beauty of BPRs. Obviously, this is paired with other confluences. Now, see, I mentioned here you took out this swing low, so we're taking out liquidity. We're taking out external liquidity. I'd class that as external. I'd class this as internal, right? Because this is a part of this price swing. And we've got great targets. You know I love this. Trendline liquidity is the best. It's the best. It's the best to target. It doesn't matter what PD array you enter from. If you got trendline liquidity, you can be confident, right? If you got the other things matching up, that you're going to take it out, right? And look how we take it out with some force and some volume. One red candle in 20 minutes. Imagine how cruisy that would be in terms of that trade. Like you're in this trade, one red candle, and then the rest is just sailing to your take profit level. So there's a BPR. Now I'm gonna write something else here too. This is just something else, right? Food for thought. If you made this far, I appreciate it. And this is something else that's important, and it applies to any PD array, by the way. This is some source. Look for a raid. And I'll write this out. And read that to yourself. Look for a rate of liquidity within a PD array you're using to target the opposing liquidity. And see if that makes sense. See if you can see the internal raid. Boom. Right there. Right with this candle. I'm going to make this thicker. That there's a swing low. Technically that is too. We've got an internal rate of liquidity. That is an extra confluence, right? After you raid this liquidity and you respect, and then you disrespect this bearish gap, right? If you entered from here, if you entered from this inversion fair value gap here, you know how many confluences you have? You know how many confluences you have? You have so many. You could put your stop loss below that low with confidence because that's actually rated liquidity, right? So does that make sense?